Good morning. So let's begin a new unit. In today's class, we will exclusively discuss income from other sources. Your income tax subject journey started in the previous semester, wherein you began with some basic fundamental concept as your first chapter, titled as Foundation to Income Tax. You have studied some basic definitions, what is income tax and what are the other types of taxes, and income tax authorities, agriculture income, exempted incomes. Then you also studied residential status and incidence of tax, followed by you had studied two heads of income out of five, and those two were income from salaries, income from house property. And in this semester, you have already completed two heads of income. Third head is profit and gains from business and profession, followed by income from capital gains. So the last head of income is a residual head of income. So when we say residual head of income, it means that any income which cannot be accommodated in the first four heads, any income which cannot be taxed in the first four heads will be taxable under the head income from other sources. So every head of income has something called as basis of charge, something which we have been studying every time we begin a new chapter. So basis of charge basically tells us the defining criteria. It tells us on what basis do we classify a particular head of a particular transaction under a specific head of income. So in order to classify any transaction under the head income from other sources, there are few important criterias. First criteria is that there should be a taxable income. So when we say taxable income, it means should not be exempted income. And the final criteria is such income should not be taxable under the first four heads of income. If these three criteria are met, then such income is taxable under the head income from other sources. And that's one of the reasons why this is called residual head of income, because we charge transaction under this head which which we cannot be charged under the first four head. So whatever is left out, whatever cannot be charged under the first four head is taxable under the head income from other sources. So this is the criteria for classifying an income under the head other source, that it should be a taxable income, it should not be an exempted income, and such income should not be taxable under the first four heads of income. If you familiarize yourself and understand this basis of charge, then technically speaking, you don't have to remember the list of incomes taxable under the head other sources at all, right? But nonetheless, we would be discussing certain incomes which are specifically taxable under the head under the head other sources. So we'll be discussing certain important incomes which are taxable under the head other sources. We might not be able to discuss all because the list will go on. So we will discuss only certain incomes which are specifically taxable under the head other sources, and which is specially mentioned in section 56 subsection. So incomes chargeable to tax the head other sources. So in this, the first one is quite interesting, and this is quite comprehensive also. So probably we have somewhere around 14 to 15 items in this list, which we would be discussing each item one by one. But this seems to be a comprehensive one. It has to be discussed in detail. This is called income from investment. Now, when we say income from investment, whenever we invest money, first of all, what do you understand by investment? Investment is a process of allocating funds in various assets with an anticipation of generating profits in the future. So that's what an investment means. It means committing funds in certain type of assets. It can be financial assets like shares, debentures, bonds, etc. It can be real assets like gold, building, land. So you're channelizing your funds, you're applying your funds in these avenues, hoping that you will earn profits in the future. And whenever we talk about investments, there are two broader categories of investments. We have first category of investment in which you have an option of capital appreciation, and then you have second category of investment in which there is no option for capital appreciation, but there is an option for regular income. And then you also have certain investments that offers you both. It offers you capital appreciation also. On the other hand, it offers you a regular income. So these are the three, I would say not two, but three categories of investments which are available at your disposal. So if you want to invest your money, you have to choose which one you want to. Now, when we say capital appreciation, what exactly do you mean by capital appreciation? Capital appreciation means rise in the value or increase in the value of a particular asset on account of demand and supply factors. For example, when we say shares, if I buy a share at a particular price today, when the share price goes up in the future, we generally say this as capital appreciation, increase in the value of share price. Similarly, it can be cryptocurrency like Bitcoin. People invest in Bitcoin with an anticipation that the value of Bitcoin will increase and therefore the worth of their investment will go up, which results in capital appreciation. Same thing happens in case of gold also. When the gold prices go up, in case if you already have gold, then the value of the gold will increase, the worth of your investment will also increase. So there are certain types of investments in which you will have capital appreciation. But on the other hand, there are certain types of investment in which there is no capital appreciation, but there is only certain amount of return what you can generate periodically or at the end of investment tenure. For example, fixed deposit. When you deposit your money under FD scheme of a bank, the bank promises to offer you a regular rate of the bank will promise to offer you regular income in the form of interest, which means that if you have deposited 10 lakhs for a duration of 5 years, after the lapse of the investment duration or at the time of maturity, you will get back your principal amount as it is. So if you have invested 10 lakhs, you will get 10 lakhs back after certain duration. In our example, it's 5 years. But the value of that 10 lakhs what you have investment will remain same, it will not change. Then why are you investing if there is no enhancement in the value of investment? The reason why you're investing in a fixed deposit is because you know that the value of investment will remain same, but you're investing because you want some sort of a regular income in the form of interest. So bank will give you certain interest at a specific interest rate, which is already informed to you at the time of opening the fixed deposit. So in this form of investment, you see there is no capital appreciation, but there is regularity of income. So we can say the first category of investment is one which offers you capital appreciation. And the second category of investment is one which offers you regular income. So the choice is left to you which one you want. There are certain category of investment which offers you both appreciation plus some sort of a regular income or returns. So now the third one seems to be interesting because you're getting both. You're getting both. Now, obviously, given a choice, you want both, right? We always want more from our money. So in case of shares, you see, shares can produce both. It can give you capital appreciation. A 10 rupees share can become a 10,000 rupees depending on various factors, right? On the other hand, shares can also offer you returns in terms of dividends. So companies do declare annual dividend, interim dividend. So that can also be your returns. So there is capital appreciation also, there is regular income also. Both are possible in case of shares. But in case of fixed deposit, capital appreciation is not possible, only regular income is possible. In case of debentures, only regular income is possible in the form of interest, but there is no capital appreciation. In case of bonds also, only regular income is possible, but there is no capital appreciation. In case of gold, only capital appreciation is possible because the value of gold, when it goes up, the worth of your investment will increase. But gold does not offers you any regular income as such. So gold does not gives you interest or dividend. Let's say you have invested in a house, you have bought a house. So the value of house can increase. So there is a capital appreciation. On the other hand, you can also generate regular income by letting the house property on rent. So the rent what you receive will become your regular income. And on top of that, the value of the house can also increase. So there is both capital appreciation also is there and regular return is also there. So the reason why I have split this investment into three categories to help you understand, because you don't find this classification in a income tax act. There's nothing called income on investment and classification like this. This is something which I've done to help you understand that any kind of capital appreciation generated on a financial asset or a real asset is taxable under the head capital gain. For example, I bought a share for 100 rupees. After 3 years, the value of share has become 5,000 rupees. So in case if I sell that share for 5,000 rupees, which I had purchased it only for 100 rupees, the profit is called capital gains. Any profit arising on account of transfer of a capital asset is called capital gain. So sale, form of transfer, share is a financial asset, which is a capital asset also. Likewise, I buy a land for a certain price and I sell that same land at a higher price in the future. So the difference is called capital gains, which has arisen on account of increasing the value of capital asset, which is called capital appreciation. So capital appreciation is taxable under the head capital gains. But what about regular income, which you get on your investment? It is taxable under the head other sources. For example, dividend on shares, interest income, right? So dividend and interest can constitute your regular income, which is taxable under the head other sources. So that's the reason I wanted to ensure that you understand the logic behind this classification. So you should know where capital appreciation is taxable, and you should also know where regular income is taxable. So this is what we will be discussing now, that on what do you get dividend? You get dividend on shares. So first you have dividend, which you get on shares. Then you have interest. And what do you get interest on? Interest on securities. What are securities? Securities are financial instruments like bonds, debentures, on which you get interest. Then you also get interest on government schemes offered through post office or other nationalized banks. What are government schemes? Government schemes includes National Savings Certificate, Kisan Vikas Patra, Sukanya Samriddhi Yojana, and you also have post office deposit schemes. So all these schemes are under the custody of Government of India. Then you also have banking products. So banking product includes your fixed deposit, savings account, term deposit, right? All this. So on this also, what do you earn? You earn interest. So the point here is that capital appreciation is taxable under the head capital gains, and the regular income, which is in the form of interest and dividend, is taxable under the head other sources. So that's the whole point of me explaining this concept of investment. So what about dividend? What is the taxability of dividend? Is dividend taxable or not? So what is the tax treatment? So as far as dividend is concerned, again, dividend can be split into three categories. Dividend from domestic or Indian company. Then again, dividend from foreign company. And you also have dividend from cooperative society. So the tax treatment differs depending on the source of dividend. First of all, what is dividend? I need not explain you the meaning of dividend, because you are aware that dividend is nothing but the profits which are distributed to the shareholders. So profit which is distributed to the shareholders is called dividend, right? So let's understand what is the taxability of dividend. What is the tax treatment of dividend in case if you have earned dividend on your investment? You have invested in shares, right? And you have received dividend from a particular company where you have invested. So whether dividend what you receive is taxable or not, is dividend taxable in the hands of shareholders or not? So that is what you have to learn. Now, as far as your batch is concerned, for your batch, the rule is, when I say your batch, I mean we are following assessment year 2019-20. So as far as assessment year 1920 is concerned, dividend received from Indian company is exempt under section 10, subsection 34, up to 10 lakhs. What about dividend received from foreign company? Dividend received from foreign company is fully taxable. And dividend received from cooperative society is also fully taxed. So this is the tax treatment of dividend received. So when we say income from investments, right, here we are referring to how do we treat income in the form of dividend and income in the form of interest. Income generated in the form of capital appreciation is anyways not taxable under the head other sources because it gets taxed under the head capital gains. So we have to discuss only about the taxability of interest and dividend. So as far as dividend is concerned, I'm sure you're clear now that dividend from an Indian company is tax exempted if the dividend is up to 10 lakhs. If it is above 10 lakhs, then it becomes taxable. Dividend from foreign company. Now, another point which you have to remember is that dividend, when we say it is exempt up to 10 lakhs, what if I receive a dividend of 11 lakhs? Is the entire amount of 11 lakhs taxable or only the excess amount 1 lakh is taxable? The answer is anything in excess of 10 lakhs will become taxable, which means in my case, only 1 lakh rupees will be taxable. So dividend up to 10 lakhs is exempt from tax. So these are the things which you have to keep in mind. Now, the next segment here is interest on securities. Now, interest on securities is a very comprehensive concept. It requires for you to pay a lot of attention because we have a big classification here. So let's discuss that as a separate chart. And sometimes you are asked an exclusive question in section B or section C only on interest on securities. Even though we are discussing just one of the income which is taxable under the head other sources, but the concept of interest on securities is so big that you might get an exclusive question in the examination. So therefore we will discuss interest on securities little in detail now, just to make you understand the taxability. So first of all, what do you mean by security? Security is a financial asset like share, debenture, bonds. But when we say interest on securities, we have to exclude share because on share you don't get interest. So when we say interest on securities, it basically means two popular securities, which includes your debt securities. And when we say debt securities, the immediate point that comes to our mind is shares and debentures. So when we say interest and securities, it primarily means interest received either on, interest received not on share, interest received on debentures and bonds. So interest on security means basically interest received on debentures and bonds. So keep that in mind. So when we discuss interest on securities, we are discussing basically the taxability of interest received on bonds and debentures. So if you have invested your money in bonds and debentures, how will it be taxed? If you're earning interest on bonds and debentures, how will it be taxed is what you have to learn, for which you have to remember this chart. So this chart would give you an idea as to how do we go about taxing interest on securities. You already have a big chart here, but this is the chart only applicable to interest on securities, right? So as you can see here, when we say interest on securities, these securities are broadly classified into government securities, and we also have commercial securities. Government securities are those securities which are issued by either state or central government. Securities issued by government companies will not come here. So this is something which most of the students do get confused while solving the problem. They think government company comes under government securities. No. So when we say government securities, it basically means these are the securities which are either issued by central or the state government. But when we say commercial securities, these are the securities which are issued by companies. Now it can be a public limited company, it can be a statutory company, it can be a private company, it can be a government company. Another interesting point here is that commercial security also includes securities issued by local authorities. So local authorities includes your BDA, Bangalore Development Authority, BBMP, municipal corporation, city development authorities. So bonds or debentures issued by municipal corporation like BBMP or a city development authority like BDA will also come under commercial securities. So government securities includes those bonds and debentures. Generally, government does not issue debentures. So when we say government securities, it includes bonds which are issued by either central government or state government. Now, as you can see here, in this also we have two subdivisions. One is tax-free securities. The second one is called less tax securities. Now, what do you mean by this? Because this is something which you have to understand. And this is extremely important because we would be using this concept throughout this chapter. And this concept is called grossing. This concept is called grossing. Now, what exactly you mean by grossing? Now, grossing comes into picture when TDS is applicable. Now, what is TDS? TDS stands for tax deducted at source. TDS stands for tax deducted at source. So what do you mean by tax deducted at source? Now, there are certain provisions of the law which says that the responsibility, even though of paying tax, lies on the person who earns the income, but in certain cases the responsibility is given to the person not who is earning the income, but rather to the person who is giving the income. And this is extremely crucial in a country like India, where people are not very ethical about payment of taxes. So in order to address this issue, what government has done, government has made it mandatory that for certain types of income, the responsibility of payment of tax is not on the person who is earning the income, but rather on the person who is giving the income. For example, I deposit money in bank. I earn interest on my fixed deposit. So government says, okay, I might earn the interest, but there is a possibility that I may not pay tax on the interest what I have earned. So what the government says is simple. Who is giving you interest? Bank. So it is the responsibility of the bank to deduct the tax and give you the net income. So when the generator of the income, when the provider of the income deducts tax, it is called TDS, tax deducted at the source where income is getting originated, TDS. Same rule is applicable for salaried employees. When you tomorrow you start working in companies, even though you earn salary, it's your income, but your employer should ensure that he deducts tax on your behalf from your income and gives it to the government. TDS, tax deducted at source. So this is called the concept of TDS. So when TDS is already deducted from your income, it is called net income. And the process of adding the tax deducted from your net income back to your income is called grossing. So what is grossing? Grossing is nothing but adding the TDS back to the net income what you have received. So here you have in government securities, as you can see, you have two variants. One is called tax-free government securities. Now when we say tax-free government securities, these are the securities which are exempted from tax. You don't have to include this in your total income. You can straight away omit. These are not taxable. But what do you mean by less tax securities? Less tax securities here means it's not that you're paying lesser tax, but it basically means the government will not deduct TDS. Simple. Since the government is not deducting TDS on the income, so it is called less tax securities. So less tax securities are those securities on which the government will not deduct TDS. Let's say government of Karnataka is issuing has issued bonds for some developmental activity. Now I buy those bonds. I invest almost 1 lakh rupees and the government of India is paying me 7% interest, which means every year I'll earn 7%. Till the bond matures, I continue to earn 7%. And this is not a tax-free bond. This is a less tax bond. If it is a tax-free bond, whatever interest I'm getting 7,000, I need not pay any tax on that because it's exempt. But when I say less tax government bonds, it means the income what the government is giving me 7,000, on that government will not deduct TDS. It is my responsibility to calculate tax on that, and at the time of filing my returns I should pay tax on the interest what I have earned. So I should do it by myself. Government will not deduct TDS. So since government is not deducting TDS, it is called less tax securities. Simple. So why it is called less tax securities? Because there is no TDS. Government is not deducting TDS. And since TDS is not deducted, we have got gross income and we don't have to do grossing because the government has not deducted. When do we do grossing? Grossing is the process of adding the TDS back to the income. We do grossing only if it is a net income. We should add back the tax at the time of doing the calculation. So in case if TDS itself is not deducted, that means the income is already grossed. So what is the whole point of me explaining this is to make you understand that tax-free securities means you don't have to pay any tax. The entire income is exempted from tax. When we say less tax securities, you should pay tax on this. And you should pay on your own because government will not deduct the tax. There's no TDS. Government will give you full interest. You only calculate the tax and pay the tax to the government. So that's what you mean by less tax securities. Now, moving on. Commercial securities. Commercial securities, as I mentioned, are those securities which are issued by companies. So it can be a government company, it can be a private company, it can be a public company, it can be a statutory company, it can be a foreign company, it can be a domestic company. In addition to companies, local authority is also included under commercial securities. So in commercial securities also you have two variants. One is called tax-free securities. One is called tax-free securities. But the word tax-free is different here and here. So that is where you have to pay attention and try understanding. What do you mean by tax-free commercial securities? Tax-free government securities means on interest what you earn, you don't have to pay any tax. You don't have to even show that income, include that income in your total income at all. It's totally exempt. But when we say tax-free commercial securities, don't think it is exempted. It is taxable. Now you might wonder, when it is taxable, why are you calling it as tax-free? When it is not taxable, when it is taxable, why are you calling it as tax-free? The reason why we are calling this as tax-free is because the tax is paid on behalf of you, on behalf of the investor. The tax is paid by the issuing company. For example, if I buy debentures of Reliance Industries Limited, Reliance Industry Limited will give me the income, but the responsibility of paying tax is undertaken by Reliance itself. So since Reliance is giving me net income after deducting tax and the tax is already paid by Reliance, I have to add the tax back. So that's the reason it is called, you should do grossing. Here grossing is required. When do we do grossing? When we get net income after TDS, we do grossing. But when we already get gross income without TDS, then we don't have to do grossing at all. Okay. So the reason why this is called tax-free securities, because the TDS is paid by the issuing company to the government on behalf of the investor. Now, since the TDS is already paid, we should do grossing. Next, you have less tax securities. Now, in less tax securities, you have two variants, right? First of all, why is this called less tax securities? What's the reason for calling this as less tax securities? Now, the word less tax signifies that before making the payment of interest, the tax at the rate in force shall be deducted at source and deposited by the issuing company on behalf of the investor. So what happens here is that the burden of tax is borne by the issuing company. But here the burden of tax has to be borne by the investor. So the issuing company will deduct tax and give net income. So that's the difference between less tax securities and tax-free securities. So what happens is, in case of less tax securities, you should know whether you should do grossing or you should not do grossing. So if the interest amount is given, if the interest rate is given, or whether the interest amount is given. If the amount of interest is given, then it should be grossed up. But if the rate of interest is given, then you should not do grossing. For example, let's say is 10,000 received as interest on debentures of Tata Power. Okay, the transaction is like this. I'll write down here. Next, rupees 1 lakh, 10% securities, or let's say debentures of Bharat Earth Boards Limited. Okay, so the transaction is like this. The moment you see a transaction, your first job is to classify whether the security is government or commercial. That is your first job. So is this Tata Power government security or commercial security? The answer is Tata Power is a company, so it's a commercial security. Okay, so you have done the first step. Second step, under commercial security, is this tax free or is it less tax? How will you determine? The answer is it's not mentioned. If it is not mentioned, then very important, you have to assume this as less tax security. Because if it is a tax-free security, it will be specifically mentioned in the question itself that it's a tax-free security. But if nothing is mentioned, we always assume it is less tax. So this is something which you have to always keep in mind, that in case if the word tax-free is not mentioned, it is always less tax security. For example, let's say there's another transaction which goes like this, just for your understanding. Rupees 30,000, 10% tax-free commercial security. So here you don't have confusion because you know it will fall under this. Okay. So what we have to do is very simple. In this case, should we do grossing or not? See, you have to learn two things. First, you have to learn how to, first you have to do a classification, whether it is government or commercial. Second, you should know the you should classify this into tax-free and less tax. That's the second classification. Now, once you're done the second classification of tax-free or less tax, the third and the final decision what you have to take is whether you should do grossing or not. So what is grossing? Adding the TDS back the income is called grossing, right? So that's the third and the final step that needs to be done, whether to do TDS or not. So in this example, rupees 30,000, 10% tax-free commercial securities, you know that this is commercial, you know it is tax-free. So what should we do? We should do grossing. Grossing means, first of all, what is the interest earned? Interest earned is not given. So you should find out. The amount of investment is given. So investment amount is how much? 30,000. On this, what is the rate of interest? 10%. So what is the interest earned? 3,000 rupees. But this 3,000, right, is the net income, which means the company has already deducted tax and given you the net income. Right? So how did you know whether it is net income or not? Because it is tax-free. Tax-free means you should do grossing. When do you grossing? When you get net income. So therefore, now you should add back the TDS back to this 3,000 rupees. Now the process of adding tax deducted to the interest amount to the net income is called grossing. Now how do we add the tax back? There's a formula which I don't want to tell you now. We'll do that little later. Right? So this is how you should learn taxing the interest on securities. Right? Now this is what this one, first one, rupees 10,000 interest received on debentures of Tata Power. So this is a commercial security. Since the word tax free is not given, so this is less tax. So should you do grossing or not? So what does the rule says? Rule says if interest amount is given, you do grossing. But if interest rate is given, you don't do grossing. Here interest rate is not given, the amount of interest is given directly, rupees 10,000 received as interest. So you should do gross. In the next example, rupees 1 lakh 10% debentures of BEML. So here the rate of interest is given. So you don't have to do gross, right? So as we do more numerical illustrations, you'll have a better understanding. Now you might find this little overwhelming. You might think that, okay, it's going a little above your head, but don't worry, right? This is just a theory explanation. When we do problem numerical question, you will automatically understand what I've explained you in today's class, right? So we will do numerical illustration on two concepts. One is dividend and the next is interest on securities in the next class, right? So let's conclude today's class. Let me quickly take your attendance, and meanwhile, in case if you have any doubts or questions, uh, you can definitely get them clarified.